You guys asked us to take a look at Nebius, and we're doing exactly that. We actually covered this one before, but so much has changed since then that it basically feels like a completely different company now. So let's dive into what's been happening with this AI infrastructure play and why it's suddenly on everyone's radar. And the Microsoft deal on September 8th was the inflection point. But here's what's actually interesting beyond just the headline. The deal structure is deliberately vague, which creates this information asymmetry that sophisticated investors can potentially exploit. Multi-billion-dollar could mean anything from a $2 billion 5-year commitment to something way bigger, and Microsoft's not going to disclose the specifics. What we can infer, though, is the nature of the relationship. Microsoft doesn't sign infrastructure deals like this unless they've done extensive due diligence on technical capabilities, and they need capacity they can't get elsewhere fast enough. Azure obviously has massive GPU capacity, but the lead times for deploying new data centers are brutal right now. Everyone's competing for the same power infrastructure, the same networking equipment, the same GPU allocation from NVIDIA. By partnering with Nebius, Microsoft gets access to capacity without having to build it themselves, which is actually pretty smart given how capital-intensive and time-consuming that process is. The question is whether this is a stopgap measure until Microsoft builds their own capacity, or if this becomes a longer-term strategic partnership. That's what you're really betting on with the stock at these levels. And now let's talk about what actually differentiates Nebius from just being another NVIDIA reseller. The full-stack approach means they're designing proprietary interconnect fabrics, custom cooling solutions, and software orchestration layers that optimize GPU utilization rates. When you're running AI workloads, utilization is everything. If your GPUs are sitting idle waiting for data, or if your batch sizes aren't optimized, you're burning money. The hyperscalers obviously have this figured out too, but they're dealing with legacy infrastructure and backwards compatibility constraints. Nebius gets to design everything greenfield specifically for transformer architectures and the specific memory and compute patterns of modern AI models. They were first to deploy Blackwell in Europe, which tells you they've got tight relationships with NVIDIA, and they're prioritized in the allocation queue. That's not trivial. Getting early access to new GPU architectures means they can offer better performance per dollar than competitors still running Hopper or older chips. The Israel deployment they just announced is interesting because it signals geographic expansion beyond just Europe, and Israel's becoming a pretty significant AI hub with a lot of startups that need infrastructure. But the real test is going to be scaling this globally, because the hyperscalers have data centers everywhere, and latency matters for certain workloads. The $4.2 billion raise right after the Microsoft announcement, yeah, the dilution sucks for existing holders, but look at the terms. The convertible notes are at what conversion price? What's the interest rate? These details matter because they tell you how confident the institutions were when they underwrote this. If the converts are priced with a big premium to where the stock was trading, that's actually bullish because it means sophisticated investors think there's significant upside even after the run. And that capital isn't just sitting in cash. They need to deploy it fast to build capacity for Microsoft. The burn rate over the next few quarters is going to be insane, but that's expected when you're in infrastructure build-out mode. What's more interesting is the timeline to revenue recognition. Are they building this infrastructure and then recognizing revenue as Microsoft uses it, or is there some upfront payment structure? Cloud infrastructure deals can be structured a million different ways, and the accounting treatment matters a lot for how the financials will look over the next few quarters. Also worth noting, they exercised the underwriter's option on September 22nd for additional shares, which means demand was strong enough that the banks felt comfortable expanding the offering size. That's usually a positive signal. Q3 earnings on November 11th. Everyone's focused on whether there's Microsoft revenue yet, but honestly, that's probably too early. These infrastructure deals take time to deploy. What's more telling is going to be the backlog numbers and the ARR guidance. They raised ARR guidance in Q2, and if they raise it again in Q3, that tells you they're signing customers beyond just Microsoft. Customer diversification is critical here because right now the entire valuation is predicated on one relationship. Any signs that they're converting pilot customers customers to full deployments or that they're winning competitive deals against AWS or GCP would be huge. The other thing I'm watching is their commentary on Blackwell deployment pace. NVIDIA's had some production issues with Blackwell, nothing catastrophic, but enough to create delivery delays for some customers. If Nebius is still getting prioritized allocation despite those constraints, that reinforces the strategic relationship angle. And the gross margin trajectory matters. Cloud infrastructure can turn into a margin compression nightmare if you're competing on price. If they can maintain premium pricing because of performance advantages, that's a totally different business than if they're forced to match hyperscaler pricing. The AI Cloud 3.0 Ether launch in October with enterprise-grade security and compliance features suggests they're going after regulated industries and enterprise customers who can't just throw workloads on public cloud. That's actually a smart positioning because those customers pay premium prices for infrastructure that meets their compliance requirements. Valuation-wise, yeah, it's rich. Everyone knows that. The 125 to 206 analyst fair value range basically tells you nobody has any idea how to model this properly. You've got people trying to comp it to CoreWeave or other neo clouds, but the comps don't really work because the business models are different. The bull case isn't just AI infrastructure demand is high. It's that Nebius can carve out a sustainable niche, serving specific customers who need specialized infrastructure that the hyperscalers either can't or won't provide. The bear case isn't just valuation is too high. Like it's that hyperscaler pricing power crushes margins, and Nebius becomes a low-margin capacity provider without differentiation. Both scenarios are plausible. What tips it one way or the other is execution over the next 6 to 12 months, and whether they can demonstrate that the Microsoft relationship is the first of many major deals rather than a one-off. The average stuff with Uber is cool, but let's not pretend that's why anyone owns this stock. It's all about the cloud infrastructure story and whether that $4.2 billion in capital gets deployed efficiently enough to generate returns. The November 11th earnings call is probably going to be more important for guidance and management commentary than for the actual Q3 numbers, because this is still early innings and the real revenue ramp hasn't started yet. The setup heading into earnings is interesting because expectations are sky high after the stocks run, but most of the financial impact from the Microsoft deal probably won't show up for another quarter or two. So you could get a situation where the quarter itself looks fine, but not spectacular, and then it all depends on how management frames the forward outlook. If they come out super confident and raise guidance aggressively, the stock probably runs more. If they're cautious or if there's any hint of delays in deploying capacity, it could get ugly fast given how far it's run. That's the trade setup. This isn't financial advice, just walking through the key variables heading into what's probably going to be a pretty volatile earnings event. Drop a comment below and let me know what stock you want analyzed next. We're always taking suggestions from you guys.